Probably the most debated and hot IFRS additions in the recent years was the newest revenue recognition standard IFRS 15, Revenue from Contracts with Customers. It introduces lots of new rules and guidance in the revenue recognition area, and therefore in today's video I'll shortly summarize it for you. I'm Sylvia of IFRS Box, and I help people understand and simplify IFRS. I have created the IFRS Kit, a complex IFRS course for you, plus lots of free IFRS materials, so you're welcome to check them out at ifrsbox.com. So one of the hottest and biggest accounting issues whatsoever is the question, when and how to recognize revenue. Very important mainly for the companies who run the long-term contracts or complex transactions. Now let me tell you that in 2014 there was a huge change in IFRS related to revenue recognition guidance. Before the change, the guidance on revenues was spread all over the standards, and there were various interpretations too. For example, we had IAS 18, IAS 11, SIC 31, and a few more interpretations, all guiding us when and how to recognize revenue at various circumstances. It was quite difficult to identify what standard to choose in your specific situation. And also, it was sometimes conflicting and confusing too. So to come out of this unfavorable situation, IASB worked with American standard setting body FASB, and they came up with totally new revenue recognition standard IFRS 15, Revenue from Contracts with Customers. You need to apply the standard for the period starting on or after 1st January 2018 mandatorily, and from that date, all previous guidance will no longer apply and we can focus only on IFRS 15. Well, and as I have already mentioned, FASB issued almost identical standard FAS Topic 606, but there are some small differences from IFRS 15. IFRS 15 applies to all contracts with customers with some exceptions. So here's the list of types of transactions in which you look to other standards for guidance, not to IFRS 15. Lease contracts under IAS 17, insurance contracts under IFRS 4, financial instruments and other contractual rights and obligations that are within the scope of IAS 39 on IFRS 9, financial instruments, and then IFRS 10, IFRS 11, IAS 27, and IAS 28. And these are all kinds of investments from subsidiaries, joint arrangements to associates and other investments. You also do not apply IFRS 15 to non-monetary exchanges of assets between entities within the same line of business in order to facilitate sales to customers. For example, sometimes two companies swap oil or other commodities in order to meet the demand. Let me stress here that you apply IFRS 15 only to contract with customer, not to some other party. For example, you don't apply IFRS 15 to contracts with collaborating parties. The absolutely essential thing what IFRS does is that it introduces 5-step model for revenue recognition. If you want to determine how and when to account for revenue in your particular situation or transaction, all you need to do is to go through this model. So let's briefly take a look. Step number 1, identify the contract with the customer. Step number 2, identify individual performance obligations in that contract. Step number 3 is to determine the transaction price. Step number 4 is to allocate the transaction price to the individual performance obligations in the contract. And the last step, number 5, recognize revenue when or as the entity satisfies performance obligations. Each of these 5 stages has its own considerations and complications, and IFRS 15 deeply analyzes and guides us in every single step. And that's why most of IFRS 15's text is about this model. In this short summary, we'll just look very briefly at every step and outline what possibly you should look at there. Also, I illustrated this model on a very short example which is available on my website, so don't forget to check it out. Let's start with step number 1, identify the contract with the customer. The contract is an agreement between 2 or more parties that creates enforceable rights and obligations. The contract can be in both written or oral form, however, it must be enforceable, and this will depend on the legislation in a particular country. Every contract must have 5 attributes that are assessed at the inception of the arrangement. Number 1, the parties have approved the contract and are committed to perform their obligations. The second attribute is that each party's rights regarding the goods or services to be transferred can be identified. The third attribute, the payment terms for the goods or services can be identified. The fourth one, the contract has a commercial substance. And the last attribute, it is probable that the entity will collect the consideration to which it will be entitled in exchange for the goods or services that will be transferred to the customer. In relation to step number 1, the standard also prescribes when you need to combine 2 or more contracts into one contract for the purpose of revenue accounting. IFRS 15 prescribes a few criteria for that, but we won't go into many details here in this short summary. IFRS 15 deals with contract modifications too. In other words, what happens if you modify, amend, or change existing contract? While contract modification is a change in the scope, well, that's what a contract is about, the price or both, that is approved by the parties of that contract. While we shall account for a contract modification based on the character and the price of additional goods or services, and we would either account for a contract modification as for a separate contract, or as a catch-up adjustment, or termination of old contract and a start of the new one, or some combination. Again, if you need more details, please refer to the IFRS kit available on our website that covers this area. Step number 2 in the 5-step revenue recognition model in IFRS 15 is to identify the performance obligations in the contract. But what are they? Well, a performance obligation is a promise in the contract to transfer to the customer either some good or service or a bundle of goods or services that is distinct, or a series of distinct goods or services that are substantially the same and that have the same pattern of transfer to the customer. For example, when you sign up for monthly cleaning services or for monthly accounting services, and these services are basically the same each month, in this case, you would need to treat this series as one single performance obligation that is satisfied over time, not as a lot of small individual performance obligations. A contract usually explicitly states the goods or services that should be transferred to a customer, so we consider it as explicit performance obligations. But sometimes there could also be implicit performance obligations that are implied by entities' customary business practices. For example, some guarantees usually provided to all customers. Now, when there's no transfer of anything to the customer, then there's no performance obligation. Here in the second step, the crucial thing is to assess whether the performance obligations should be treated separately for accounting purposes or whether they are distinct. IFRS 15 sets the whole guidance about what's distinct and what's not distinct, plus some other considerations related to this topic. The step number 3 in the 5-step revenue recognition model is to determine the transaction price. But what is the transaction price? It is the amount of consideration to which an entity expects to be entitled in exchange for transferring promised goods or services to a customer, excluding the amounts collecting on behalf of the third parties, like some sales taxes. How shall we determine the transaction price? Well, basically we look to the contract, but it's not always the full case. Sometimes the transaction price can be variable, sometimes it can be fixed. So we need to take into account the nature and timing of consideration from the customer. So when we determine the transaction price, we need to consider the effect of all the following factors. Variable consideration. So the amount of consideration can vary because of some discount, bonuses, rebates. Then the constraining estimates of variable consideration. We also need to consider the existence of significant financing component in the contract. When the contract involves a non-cash consideration in the form of goods, services, or something else, then the entity includes at its fair value. And let me remind you, IFRS 13 fair value measurement. We should also consider the consideration payable or paid to a customer. So it can include either the cash amounts paid or payable to the customer, some credits, or other items like vouchers, coupons. And there are some other factors to consider too. Step number 4 is to allocate the transaction price to the individual performance obligations in the contract. The basic allocation objective is to allocate the transaction price to each performance obligation in an amount that depicts the amount of consideration to which the entity expects to be entitled in exchange for transferring promised goods or services to the customer. Well, how to allocate the transaction price so that this objective is achieved? The general rule is to do it in proportion to relative standalone selling prices. IFRS 15 states only 2 exceptions from this general rule: allocating discounts and allocating variable consideration. Here we won't go into details in this short video, but let me stop at standalone selling price. It is the price at which an entity would sell promised good or a service on a standalone basis at contract inception. In order to allocate the transaction price to the performance obligations, we must therefore determine the standalone selling prices first. Well, how? The best method is simply to take the observable prices of good or service sold separately, and this is by far the best evidence of standalone selling prices. However, these prices might not always be readily observable, so in these cases you need to make an estimate of a standalone selling price. And here you can use various approaches, such as adjusted market assessment approach, expected cost plus margin, residual approach, or some combination. The final step in the revenue recognition model is to recognize revenue when or as an entity satisfies a performance obligation. Under IFRS 15, a performance obligation is satisfied when a promised good or service is transferred to a customer, and this happens when the control over the good or service is transferred, while not risks and rewards as it was written in older IAS 18. So when a customer receives control, she has the sole possession of the right to use the good or service for the rest of its economic life. How a performance obligation can be satisfied? IFRS 15 introduces 2 concepts here. A performance obligation is satisfied either over time, well, in this case the revenue is recognized over time too, so that means that you would need to recognize the revenue gradually over the contract period and not as a single amount when the contract is completed, just as an example. Or a performance obligation can be satisfied at the point of time, with revenue recognized at the point of time. IFRS 15 sets 3 criteria when you need to recognize the revenue over time, and if one of them is met, then it's over time, otherwise it's at the point of time. Timing of revenues has tremendous impact on everything from the financial health of the company to its taxes, so it's very important to take care about it. Well, we have just finished an extremely brief review of the 5-step model for revenue recognition. But IFRS 15 specifically guides us also on other related topics. One of them, very important one, is contract costs. IFRS 15 specifies the accounting treatment of cost to obtain a contract and cost to fulfill a contract. Costs to obtain a contract are incremental costs. In other words, costs that would not have been incurred without obtaining that contract. For example, sales commissions paid for the acquisition contract, legal fees, bonuses to employees specifically provided for obtaining a contract, and other. IFRS 15 requires capitalizing these costs if an entity expects to recover these costs and amortize them on a systematic basis consistent with the transfer of goods or services under the contract to the customer. Costs of fulfilling the contract are costs incurred in connection with satisfying performance obligation. And the standard says that if these costs are in the scope of some other standard, for example IAS 2, 16 or 38, then an entity needs to treat these costs in line with the relevant standard. If these costs are not within the scope of other standard, then these costs should be capitalized or recognized as an asset if they meet certain criteria stated by IFRS 15. Again, we won't go into many details here. Now, how shall we adopt IFRS 15? Mandatory effective date of IFRS 15 is for periods starting 1st January 2018 or later, with the earlier application permitted. Well, how to make a transition? IFRS 15 offers two transition approaches. You can select to apply either full retrospective approach or modified retrospective approach. Under full retrospective approach, an entity must apply the standard IAS 8 for changes in accounting policy and apply IFRS 15 retrospectively to each prior period reported in the financial statements, as IFRS 15 would always have been applied. And this might be very difficult and demanding, and therefore IFRS 15 provides a few practical expedients or exceptions. Modified retrospective approach requires adopting IFRS 15 retrospectively with the cumulative effect of initially applying IFRS 15 recognized at the date of initial application. Well, this approach is a bit easier than the full retrospective approach, but anyway, there's still a lot of calculations to be made. Finally, let me give you a few thoughts about how businesses and companies should prepare themselves. First of all, accounting software and other IT systems might require significant upgrades in order to collect all important data required by IFRS 15 and make automatic accounting entries in some cases. Companies might need to reopen their existing business contracts in order to make appropriate amendments. Companies might recognize revenue earlier or later than before, which can affect the key performance indicators. Changes in timing of revenue can require adjustments to tax planning, dividend policy, and any other policy tied to revenues, like remuneration of employees. Sure, there are many different other considerations, and this was just to give you a few hints. We have just summed up the new revenue recognition standard, IFRS 15, and if you'd like to learn a bit more, you're welcome to check ifrsbox.com, subscribe to our free newsletter, and receive many useful IFRS articles, videos, and other materials. Bye-bye, and thanks for watching.